Tony, let me start with you. Is it a done deal? The market certainly went from about 65% pricing in to just under 90%. Not a full rate cut priced in for September yet, meaning people do still think there might be problems in the inflation or employment data coming up.
Yeah, so we think that it is a done deal. We think they will cut in September. We think that the reason Powell sounded maybe a little bit more dovish than maybe the market was expecting is really around three things. Number one is that they believe they're starting from a restrictive stance. So cutting is not necessarily being stimulative, it's just getting a bit less restrictive. So it's recalibrating. Number two, the market offered him the opportunity because it began to price out a full cut. If you go back about 2 weeks, we were over one cut. So again, he didn't have to counter the market. The market was down at 70% probability. And number three is the fact that they're under a white-hot political spotlight right now. So had he sounded dovish, it really just opened up, I think, the opportunity for tweets all weekend around the Fed. And this maybe helped to kind of lower the temperature just a bit in terms of that spotlight.
Meghan, does this lower the temperature? A 12 basis point drop in the 2-year yield. Will we retrace some of that?
Well, Bonnie, this was definitely more dovish than we were expecting at Bank of America. Our call has been that the Fed would not be cutting rates this year. That's largely out of consensus. And a big part of that has been the strength of the inflation data. And if you look at the recent inflation numbers that we saw just a couple weeks ago, this is more consistent with a Fed that has historically been hiking than cutting. Definitely more dovish than what we were expecting, but generally endorses our view that you want to be long duration here, particularly at the 5-year part of the curve.
Look, he's clearly very concerned about the labour market. He called it a curious kind of balance where you're seeing supply and demand soft. And I guess, is he waiting to see which one is going to be more important going forward? And will we see that in the next round of jobs data, Tony?
So we definitely think they're going to still be data dependent. We think what he's saying is that we're going to maybe try to look through the inflationary risk, because we agree inflation is higher than what they'd like, but they're already talking about it being maybe a one-time level adjustment versus necessarily feeding into longer-term expectations. So we think the data will be determinant around the labor market. If we see the unemployment rate rise more quickly, they will then cut more aggressively. Our expectation is to see a modest rise. We'll get 2 cuts this year, all part of this recalibration, but we avoid recession, so we don't need a significant string of cuts from the Fed as we move through 2026.
I mean, Meghan, he also did outline several other possibilities, maybe not as base case, but you could have wage dynamics weakening, for example. You could have inflation expectations moving up again. They're by no means completely anchored. I mean, they are for the moment, but there have been times when the Fed has been very worried about that. I mean, what probability do you give to the other outcomes being the case?
Well, one very important, I think, point to make here in terms of the market's response today is that while nominal rates are declining and compressing, inflation compensation is actually on the rise. We like being long break-evens in the U.S. We like being long inflation in the U.S. versus the euro area, because if we do have a Fed that's cutting in this environment where inflation is still a far cry from the Fed's target, we think that the market should be showing more signs of this inflation target moving higher and becoming unanchored from the conviction that the market has historically had in the Fed being able to achieve 2% in the long run.